On the evening before Monday, December 3rd, investors in gold were given what seemed to be a gift that they had been waiting years for. Within a matter of mere minutes, the price of gold began ripping higher, peaking at over $2,144 per ounce. And given the fact that this was taking place directly after November, in which the price of gold saw the highest monthly close on record, it seemed as if a new bull market had just been born. But unfortunately, as many gold bulls feared, this excitement was short-lived, because as quickly as the price had skyrocketed, it fell right back down to where it was before. It seemed as if the price of gold was getting hammered back down by some invisible hands that just control the price of gold. A move that would extinguish every last drop of hope that precious metals investors have been hanging on to by a thread for years. But what actually happened here? Why is it that the price ripped up to all-time highs in a matter of minutes and then just as quickly collapsed back down to lower than it was before? Well, I'm going to tell you exactly how and why this happened. And despite what some people may want to believe, this has nothing to do with naked shorts, manipulation, or rigged markets. And that's actually a good thing, because once you understand what happened here, you'll be able to protect yourself from getting suckered into this with any other assets. And you'll actually even be able to profit from this happening when you see it unfolding everywhere else. And the first thing we need to understand here is how tops and bottoms form in markets. An asset price will stop falling once all the potential sellers have sold, because at that point, there's nobody left to sell. So it can't go down anymore. The only thing left to happen is for the buyers to buy. This drives the price back up, confirming the bottom is now in. And this is why most people actually sell at bottoms, because bottoms happen when most people are selling. In the exact same way, this is how tops form as well. An asset price will stop rising once all the potential buyers have bought. At this point, there's nobody left to buy. The only thing left is for sellers to sell. This drives the price back down and confirms the top. This is why most people buy at tops, because tops happen when most people buy. This is why you see support and resistance lines form on charts. These are not magic lines that some people are just arbitrarily drawing. Support and resistance levels are simply the levels at which most buying and selling occurs. This creates visual floors or visual ceilings that the price tends to bounce off of. So if we know that tops are put in when most people are buying, let's take a look at what that looks like on the chart. This is the gold chart going back to 2020, and we can see three major tops that have been put in above the $2,000 level. Each one of these tops at around 2,000 represents a massive amount of buying. Again, those tops are put in once the buying has been exhausted, and the buying is exhausted when most people who are going to buy decide to buy, which means there are countless investors who bought near $2,000 an ounce and have been sitting on those losses for years. So at this point, we have to ask a very important question. Why does this happen? Well, studying human psychology and investor behavior has revealed that people hate losing way more than they like winning. Very simply put, losses hurt way more than profits feel good. This is one of the things that I teach members of Heresy Financial University how to recognize and avoid, because it crushes your performance over the long term. It's why most small and retail investors never make any money over long-term investing. They don't want to take the small loss, so they sit on it until they get back up to break even. But then that small loss inevitably turns into a large loss. Those large losses then pile up and destroy the performance of the overall portfolio. And if a rally ever does occur again, those investors take that chance to sell it at break even, which means that most investors usually end up with a ton of small gains and a few massive losses, and they never have a positive return as a result. The ones who actually do make money investing do the exact opposite. They never take large losses, and they have a few positions with gains that are so large that those gains drive their overall performance of their whole portfolio. And these areas around $2,000 per ounce represent huge pools of investors who are doing that exact same thing, waiting for a chance to sell at break even. They've been sitting on gold dropping down to 17 $1,500 or even $1,600 per ounce for years, waiting for a chance for gold to come back up so they can sell. This is why resistance has formed right above $2,000 per ounce, because every time it gets up here, investors sell. Before we get any farther, I need to clarify that I have never recommended trading gold. I've always recommended long-term holding as a good chunk of your overall portfolio. And today's sponsor, One Gold, has been a long-time partner of this channel, and they're one of my favorite ways to hold gold for the long term. The main reason I like One Gold for a portion of my precious metals holdings is because it's just not smart to keep all your eggs in one basket. Many people, for many different reasons, choose to have some of their gold held physically and some of their gold in storage. All it takes is one bad actor to think that you might have something of value to put you and your family's life at risk. That's the main reason why I always tell people on YouTube that those gold bars that are sitting there in my video, those are fake. They're made of plastic. They're props. You can buy them on Amazon for a couple of bucks. It would not be the smartest move of me to have millions of dollars of gold sitting out in bars just out in the open. In fact, because of my situation, I don't hold almost any gold physically at all. Because of what I do for a living, it just wouldn't be smart at all. For others who maybe live in an unsafe area of town or an apartment, or you travel all the time, or you are in a storm or disaster prone area, you may be in a similar situation in which physically holding your gold may not be the smartest move, at least not for all of it. Some things that are very important to look for with precious metals storage are: number 1, insurance; number 2, third-party auditing; number 3, that the metal is fully allocated and physically segregated; and number 4, that you can choose to store your metal in a country with no history of precious metals confiscation. Now, on top of the extra security that One Gold can offer, it also makes it easier to get your foot in the door by not having to buy a full ounce coin at a time. Instead of saving up the dollars first and then going to spend $2,000 a time on 1 ounce of gold, you can simply use your account at One Gold to purchase any dollar amount, and over time you can build up the amount of gold you have in storage. And by the time you have 1 or 5 or 10 ounces, whatever you want, you can either redeem it and have that metal delivered to your doorstep, or you can sell it and collect the cash back into your bank account. So whether you need a cost-effective way to dollar cost average into your metal, or you're looking for something far more secure than holding it yourself at home, or you're just looking for a simple done-for-you solution, One Gold has you covered. Link is in the description below. Okay, so now we understand the trading psychology that led investors to, over time, both buy near all-time highs around $2,000 per ounce and also start selling there, which created this long-term resistance level. So what happened on the evening before Monday, December 4th? Because to the untrained eye, this looks suspicious. Well, basically, when the price of gold finally hits a new all-time high, all the investors that bought around $2,000 per ounce and have been sitting on losses for years finally have a chance to sell at break even or at a slight gain. It's like a Christmas miracle. They take the gift, they sell all their gold, and they thank God that they didn't have to take a massive loss like they almost did just 60 days ago, down near $1,800 per ounce. Okay, so that explains the selling, but what happens next? Shouldn't the rally continue now that everybody has sold? Well, we really have 2 potential options here, 2 paths that we may move forward. Option number 1, the breakout is confirmed and we rally to new all-time highs and a new bull market is established. Option number 2, this is a false breakout, it fails, the price falls, and we'll have to wait for another chance another day. Given the price action so far, it does look like a false breakout. But let's go through what each of these paths looks like so that we can watch it unfold. First, let's look at what it would look like if this does end up being a false breakout. First, the selling is powerful enough to overcome all of the new bulls and it soaks up any of the new buying pressure. The price falls back down below where it was before. As a result, the market interprets this as a failed breakout. This is a bearish signal. It turns more holders and recent buyers into sellers, causing the price to continue to fall for some time. The hope for a breakout to a new all-time high and a new bull market is not gone forever, but it is delayed. More importantly, this failed breakout brought in a new round of buyers who are now sitting on losses. This adds to the difficulty next time of hitting a new all-time high. This solidifies resistance at around $2,000 per ounce yet again. And if you're wondering why at this point I'm talking about this like it hasn't happened yet, even though when we look at the chart, it looks like it's already a done deal, don't worry, I'll explain that at the end of the video because it's not actually a done deal yet. But the second way this plays out is a confirmed breakout. What this looks like is the selling ends up not being enough to overcome all the bulls and soak up that new buying pressure. So the price does fall back down, but it doesn't stay below where it was before. As a result, the market sees this as confirmation that the new bull market is real. This is a bullish signal. This turns more sellers into buyers, which means the price then bounces and begins to rally even higher. The hope for a new all-time high is confirmed. This brings in a flood of new buyers, all hoping to profit from this new bull market and get in early. The increasing all-time highs and the new rally starts to make news headlines, and the trend has begun. The bounce after the decline and then the subsequent rally is a visual confirmation that past resistance level has now become the new support level. What was the ceiling is now the floor. You've broken up through that level, and now what used to keep you down holds you up. And this happens because all the potential sellers, everybody who was thinking about ever selling, have now already sold, and it wasn't enough to bring the price down, which meant that the only thing left to happen was buying, which drives the price back up. And if the price ever does get that low again, the market interprets that as a great place to buy, further solidifying it as a new support level. It's important to remember that this price action is completely 100% normal. It happens everywhere. Across every stock and every asset that can be charted, you will see this pattern unfold. Markets are also fractal, which means that this pattern is time agnostic. You will see it unfold intraday as well as over extremely long time periods, months or even years. Whenever you see a breakout to all-time highs, almost always you see it come back down, retest the old resistance level to see if it'll hold as new support. If it does then close at or above that prior resistance level, it is confirmation that will likely stay above it now and move into a new rally. If it closes below, it's a false breakout and we'll have to wait for another chance later. Okay, so why am I acting like this isn't already a done deal as of the time of this recording? Well, it's because when we look at the time frame over which this has played out, we are looking at many years of price action. You can get a better scope of this if we take a look at the price of gold going all the way back to 1970, how significant the resistance in the price of gold has been. Given the fact that we are looking at something that is unfolding over such a large period of time, it's going to take a lot more than just a few minutes of gold trading at an all-time high for this to be confirmed. November's monthly candle closing at an all-time high for a month's end is a great start, but it's nowhere near enough. In fact, it was so close to prior resistance that it basically just counts as closing at resistance. From here, if you are truly bullish on gold, you'd want to see this pattern unfold over a monthly scale. You'd want to see a breakout and then a retest and then a bounce to confirm the new bull market. And beware, because that pattern can be huge and can sucker a lot of people into losing money if they're trying to trade that. Now with gold, obviously, I view this as a long-term play. I never recommended trading gold. I've always been very bullish on gold ever since I started posting videos on YouTube back in 2019 when gold was below $1,500 per ounce. And I continue to view it as a cornerstone piece of a solid portfolio, regardless of these short-term price moves. But seeing these moves play out and understanding how they work and why they happen will absolutely help you make way more and lose less on everything else. And of course, if you'd like me to help you do that, join Heresy Financial University before the end of the year using code LASTCHANCE2023 so that you can get grandfathered into this year's pricing forever before prices go up next year. As always, thank you so much for watching. Have a great day.